the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Hello, this is Hall Martin with Investor Connect. Today we're here with Grant Newlin of Newlin Ventures. Grant, thank you for joining us.
Thanks, Hall. It's good to be with you. Nice to chat with you again.
Great. Glad to have you with us today. So tell us more about your background before investing in early stage companies. What did you do before this one?
Sure. Yeah, I started my career as a management consultant at EY, really working on a variety of projects around the financial crisis and getting banks through that. I then switched over to investment banking, worked in M&A, sell side, buy side for a middle market shop in Chicago. Then transitioned into a corporate FP&A, wanted to get see how the big players in the corporate ivory towers, how they work. And I worked for the CFO and president of Kraft Heinz, where I got my start in food tech. And then from there, as I was doing my first initial angel deals, I came across Newlin Ventures, where I'd done a few investments, small investments, angel investments, and ran deal flow there for a couple of years before starting my own company at Newlin VC.
Well, great. So what excites you right now?
Sure. Well, there's a lot of exciting things. I mean, the entire ecosystem, as I'm sure you're well aware, has just changed dramatically over the last few years, 5 years, 10 years, I'd say, especially in places outside of the Bay where you've seen a lot of VC activity in startups for some time. But you're really seeing that expanding across the rest of the country and even other parts of the world, which is really exciting because there are a lot of new niches and new industries and new types of technologies that are popping up all over. Specifically, right now, what's exciting me is food tech. And that's really a general term I use for anything from what I call land to label, right? So that can be the agriculture side, that can be the supply chain, that can be working with big CPG companies, restaurants, anything on the software side to help facilitate all of that, or even things such as consumer brands.
Well, that's great. So what's your advice for people investing in startups in the food tech sector?
Sure. I think food tech is a bit different than your traditional, maybe high-tech SaaS businesses that many of us are used to seeing. Food tech often involves heavy manufacturing components. It involves physical products, whether it be building bottles or actually supplying and sourcing food. And so the entire funding runway and the funding roadmaps is quite different than, and it's usually more intense and more challenging, I would say in many ways, than a couple of software engineers that are developing a software product. Obviously, there's high fixed costs involved with the food business. And again, a lot of your funding requirements are based on volume, which is a lot different than just building an MVP of an app, let's say, that you can then take and scale out much more quickly. So it presents a lot of different and unique challenges, that's for sure.
So for people running startups in the food tech sector, what have you learned to advise them on?
The biggest challenge that I've learned as an investor, and then also working, I did a quick internship at Poppy Lou Lemonade, which is run by Melanie Kahn, who created the Fairlife milk brand, which is now a joint venture with Coca-Cola, several $1 billion. I've learned through working with her and through my own investing that companies in food tech really need to think extra hard about their funding roadmaps. And the traditional seed rounds of $1 million that get you 18 months runway don't really apply. Oftentimes you need more money than that. Most of the time, the runway is not as long. And as an investor, I have to be a bit comfortable with that. And then again, anytime you have the physical product, you have to deal with gross margins. And if you have, for instance, let's just use you're building lemonade bottles. And if you have negative gross margin, well, then your cash burn is totally different prospect, right? You have situations where potentially you're losing money on every unit that's sold. That's not something that you want to have. So making sure that you get some bit of positive gross margin in the beginning, just so that you can keep your cash flow stable, and then hopefully getting scale later on to really improve those is kind of the best way to go about it.
Well, that's good advice. So how is the industry evolving for the food tech sector? What are the changes you see there, and where do you see it going?
Sure. Well, you've seen a huge shift in the industry. Before it was always dominated by large CPG players, I give you a few in Chicago, the Kraft Heinz's, the Tyson's, the Mondelez's, all of these, right? They dominated the space. They dominated innovation. I worked with the heads of R&D at these companies, and they tend to pump lots, hundreds of millions of, not billions of dollars into brands, and they have the marketing capacity and the production capacity to spin them up and get them to scale. But oftentimes the innovation is much more incremental. And as you see such a shift from convenience towards better for you products, towards healthier products, the whole dynamic and the game has changed. So you see all these young brands being scooped up, these startup CPG brands, for instance, being scooped up for 50, 100, sometimes $500 or $600 million by these large CPG companies, because they see it as a way to bolt on and really kind of right that ship and accelerate the change that they're trying to build to adapt to consumer trends. And as a result, you've seen the VC world adapt with that. So, for instance, in Chicago, in my hometown in the Midwest, you've got Newlin Ventures now that has recently popped up. Kraft Heinz evolved. We've got now Valor Equity, the largest PE/VC in town, with Newlin Ventures. A lot of people haven't even heard of this, but Newlin Ventures, to my knowledge, is the largest food tech-focused fund out there. It's a roughly $400 million JV between Valor and Starbucks, and I believe a couple of others. And they actually placed that in Chicago, of all places. I mean, so you're just really seeing the later stage food tech dollars, if you will, going after trends that you're seeing in the industry.
It sounds like a lot of money going after some good deals there. That's great to see. It used to be little money going after it, but it seems like you said it's heating up.
Absolutely. And where we come into play is really being that critical link between these startups, which may not have any funding, or maybe they just have raised a little bit, friends and family, and being that connecting point to those larger CPGs. So a lot of times these companies won't take a look at deals unless they have good chunk of revenue, et cetera, et cetera. And we can be that point to get them to where these companies are ready to be presentable in terms of the metrics that these later stage Series B, Series C, and later stage venture CVCs or just regular venture funds are looking for. That's kind of where I've found my niche, and I found I can provide a lot of value.
So what's your investment thesis for this sector? What's your criteria that you look for in startups?
Sure. So at Newlin VC, we're focused on three main areas. It's IoT and hardware. I feel like we have an advantage there versus potentially digital and just pure SaaS, which is dominated by the West Coast. Again, we're looking for niches. We're looking at underserved markets. In the Midwest, we have a large manufacturing base. We like to build things. And so IoT and hardware is taking hold really strong in Chicago with the Bosch Connectory, with the M-Hub Lab, and a variety of other kind of innovation hubs in the area. We'll also look at consumer, which Chicago is the third largest city in the country. There's a very large consumer base, and kind of tied to that consumer piece is really the food tech, as we talked about. So people got to eat, they got to drink. And again, you're seeing all these shifts towards better for you food products. You're seeing, of course, all of the plant-based proteins now. And it goes beyond that, really, even things in the packaging, right? Whether it's bio-based plastics, and got one company that has a Bontemps in the portfolio based out of Toronto that it's just a tea brand. It's a tea brand targeted towards millennial women, but they've got a very unique package with their tea bag, which is corn-based, which most people don't know, but most, if not all, tea bags have all kinds of pesticides and chemicals in them, and you're dipping that into your hot water and you're really drinking that. And on top of that, you've got these large CPGs that need to adapt, right? They have such big Titanic ships that they're trying to move, and it's very hard for them to. You can go and take, for instance, high fructose out of ketchup or out of mayo, and that's considered a huge deal. But in cases where you've got Sir Kensington's ketchup going at you against Kraft Heinz, which is selling at a 3 times price point, you've also got like the Great Values of the world, which are going on price for those that just see ketchup for what it is, in many cases just the condiment. Why would I spend any premium amount on that? And then you've, of course, got the D2C online components with Amazon that are really putting pressure. So I've got a company in the portfolio called Pair Commerce, which is really trying to address some of the challenges that these large CPGs are facing in the D2C world and helping with their digital marketing efforts and things like that.
Do you have specific criteria for deals that you look at for your portfolio? For example, do they have to have revenue? And if so, how much?
They don't have to have revenue. We are looking for the best founders. And for me, again, I think if we can find the Zuckerbergs of the world that are 1% of his talent or what he's growing, I think we'll find a lot of winners. And so when we assess companies, we're really looking for teams and solid teams that have experience in the industry that they're working in, that are real hustlers, that are very responsive and hyperactive in communicating, and just are able to see things in a different light than whatever the current state of affairs is. So I use the analogy, if everyone's playing checkers and they're playing chess, and they are able to clearly articulate that. So we don't need revenue. We like to see pilot data. We like to see some initial partnerships with the majors, whether it be major CPG or whatever industry they're in, that they've tested and they've gotten feedback from customers and are able to do some A/B testing of sorts to kind of prove out their model. Revenue's nice, but really that's not our main concern. Again, it's addressing the team aspect, it's seeing the vision and what they're trying to build.
Well, that's great. So what are the challenges that startups in this space face with regards to regulatory or technical or market?
Sure. Obviously, in food tech, you're going to have a bit of FDA issues, but I haven't run into too many problems there. I think most of the companies are aware of certain labeling requirements and things of that nature. So on the regulatory side, it's not nearly as onerous as, say, maybe medtech, which has to deal with all kinds of trials and drug approvals and things like that. Again, I will point to the oftentimes manufacturing component, or anytime you're building a physical product. So that plays also for hardware, for IoT, where you're having to build physical units and you have to look at your BOM costs, your bill of materials. You have to look at all of your COGS costs and your shipping costs if you're shipping consumer goods, and where your customers, and if your manufacturing facility is on the East Coast and you got to get in your main customer is in the Southwest, how are you going to get that product over, and how are you going to be able to do that in a cost-effective way when you're a startup? So those are kind of the main challenges I see anytime you're building something physical that's not just a pure software play.
Very good. So what sectors out there or applications do you see in your area that are good immediate opportunities for investors to pursue?
Sure. I would go again to this whole better for you movement. I try to eat as clean as I can myself. You're seeing such a shift. Before, again, it was all about, well, let's just use the fast food model, right? It was so innovative when McDonald's came out and had this cheap fast food that people could get very quickly. Well, now that's kind of standard. I mean, you've got the Grubhubs of the world, they can deliver food to your door very quickly. That's kind of a given. Now it's, well, what are we putting into our bodies? What are we eating? What are we consuming? And is it good for us? And especially with the younger generations, this is really becoming one of the most important, if not the most important aspect of kind of the latest in trends and consumer tastes. And so with that in mind, that's what I usually look for if I'm doing anything in food tech, saying, okay, well, how is this product better than what's out there today for me as a consumer? And I often look at it as from a consumer lens, right? Because we do a lot of consumer deals. I do a lot of food tech deals. I try to be as current as I can with eating the latest and cleanest foods. And so that's really important.
Well, that's great. So in the last few minutes that we have here, what else should we cover that we haven't?
Sure. I think we hit on most of the important points. Again, I would like to reiterate just having spent some more time the last year or so in this space, that starting a high fixed cost business in food is often, again, more challenging than these SaaS types of businesses. And so you have to be laser focused on your operational efficiencies and cost containment. You have to decide whether you're going to start building in-house versus potentially using a co-packer. I've seen success on both ends, but if you're able to kind of build in-house and start that manufacturing, if you can get enough capital early on to do that in-house, I think I've seen even more success that way, because you have a lot more control over the product. You're able to keep your eyes on things much more diligently. I've seen issues with co-packers when you're a small brand, that the co-packers really don't pay much attention to you because you're just so small, you're a blip on the radar, and things like the units coming out with the package being turned upside down or something like that can easily happen. And there's not a lot of negotiating power you have to work through that. So to the extent that you can, kind of in the case of a consumable, to get enough funding to get your own equipment and do small test runs internally, I think you'll be better served in the long run, at least from the initial data points that I've seen.
Well, that's great. Well, how best for listeners to get back in touch with you?
Sure, absolutely. Well, they can go to my website at www.newlin.vc. They can also send me an email at grant@newlin.vc.
Great. We'll put those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Sounds great, Hall. Appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.